When the US government shuts down, most people see it as politics. But if you're a trader, you need to see it as a warning. Because every shutdown teaches lessons about discipline, about risk, about survival in the face of chaos. The market doesn't care about speeches in Congress. It reacts to fear, uncertainty, and weakness. And if you don't pay attention, you'll miss the truth. America's shutdowns hold lessons that every trader must heed. Point: wanting uncertainty is the market's biggest enemy. Every shutdown in America begins with the same story: political leaders in Washington failing to agree and the government grinding to a halt. The very first effect isn't just on workers or agencies, it's on confidence. Because when the government shuts down, nobody knows how long it will last or how bad it will get. That cloud of doubt spreads like wildfire and markets hate it. Uncertainty is poison to markets. Investors can handle good news and they can even handle bad news, but what they cannot handle is not knowing what comes next. During shutdowns, government data releases like jobs reports or inflation figures are often delayed. That means traders and institutions are flying blind. They don't know if the economy is strengthening or weakening, so they start to hedge, pull back, or panic. That nervousness shows up in stocks, in Forex, in commodities. For US traders, this is the first lesson. A shutdown teaches uncertainty, punishes the unprepared. If you walk into volatile conditions without a plan, you're handing your account to the market. Shutdowns create wild swings. One headline out of Washington and the S&P 500 can move 2% in minutes. The dollar can spike or drop against the euro or pound, not because of fundamentals, but because of fear. Think about what uncertainty does to traders. The emotional ones, those who chase every move, get chopped up. They buy the spike, then get stopped out on the reversal. They short the panic, then get squeezed when it calms down. The market feeds on their fear and chews them up. But disciplined traders understand the rule: uncertainty isn't the time to gamble. It's the time to protect capital. If you don't have clarity, don't force trades. Sit back, observe, and wait until the probabilities lean in your favor. Shutdowns don't last forever. Eventually, clarity returns. And when it does, the traders who preserved capital during the storm are ready to strike. The shutdown also teaches us something about human nature. Politicians may stand in front of cameras acting confident, but behind the scenes they're scrambling. Markets do the same. Outwardly, traders act certain. But when the future is unclear, most of them are just guessing. Your edge isn't about being right during uncertainty. It's about being patient enough not to join the stampede. Shutdowns prove this lesson again and again. The market doesn't reward those who act first. It rewards those who wait for clarity. Uncertainty kills the reckless. But for those who respect it, uncertainty becomes a filter. It wipes out the weak hands, and when the dust settles, only the disciplined remain standing. That's why the first and most important lesson from America's shutdowns is simple. The market's biggest enemy is uncertainty. And if you want to win, you need to respect it, not fight it. Point 2a: discipline beats emotion. Every shutdown brings chaos in news headlines, breaking updates, politicians blaming each other, and markets reacting violently. This chaos feeds a trader's worst enemy: emotion. Fear, greed, and impatience start to dominate decision-making. Traders see the market spiking and they panic buy. They see it dropping and they panic sell. They chase every move, thinking this is the big one, only to get chewed up by volatility. But shutdowns teach us a different truth. Discipline always beats emotion. Think about Washington. When Congress panics, the system collapses. When leaders stay disciplined, even in heated debates, the economy runs smoothly. The same is true for traders. If you let headlines and fear control your trading, you're finished. But if you remain calm, focused, and disciplined, you come out stronger. Shutdowns create false moves. You'll see the S&P 500 dive on news of a stalemate, only to rally the next day when talks resume. The dollar will crash on fears of missed debt payments, only to soar back as investors run to safety. These swings are designed to trap the emotional trader, the one who trades without a plan. Discipline, however, is your shield. Discipline means you follow your rules, no matter what the market throws at you. It means not chasing every spike, not letting FOMO drive your decisions, and not letting fear of loss push you into reckless trades. Discipline is setting stop losses, sticking to position sizes, and walking away when conditions don't fit your system. The truth is, shutdowns are a mirror. They reveal who's trading with a plan and who's trading with emotion. They expose the gamblers, the chasers, and the weak hands. And every time, it's the disciplined traders who survive while the emotional ones blow up. Lesson 2 is clear. Shutdowns remind us that discipline is not optional. It's everything. Emotion destroys accounts. Discipline builds them. Point 3E, risk management is survival. Shutdowns are unpredictable. No one knows if they'll last 3 days or 30. No one knows if politicians will resolve it quickly or drag it out for weeks. That uncertainty is the same in trading. You never know how long a storm will rage. And the traders who survive aren't the ones with the best strategy. They're the ones with the best risk management. Think about the government. When revenue stops flowing, leaders are forced to prioritize. They protect the most critical payments first, like debt obligations, to avoid default. That's risk management at a national level. Traders must think the same way. When markets are volatile, you don't go all in. You cut your size, set tighter stops, and protect capital. You prioritize survival over profit. Shutdowns are brutal teachers of this lesson. Volatility increases, spreads widen, and moves become unpredictable. If you're over-leveraged, one wrong move wipes you out. If you're chasing losses, you're drowned. But if you manage risk, if you risk 1% per trade, if you cut losers quickly, if you don't overexpose yourself, you can survive even the worst shutdown storm. And survival is the real edge. Too many traders think the goal is to double their account overnight. Shutdowns show the truth. The real winners are the ones who live to trade another day. Because once stability returns, once markets calm, those who protected capital are positioned to take advantage of the real opportunities. Lesson 3 is clear. Shutdowns prove that risk management is not just part of trading. It's the foundation. Without it, you won't survive. With it, you can withstand anything, even Washington's chaos. Point 4, the big players control the flow. Shutdowns remind us of something traders often forget. We don't control the market, big players do. Think about what happens during a shutdown. While the public panics, while headlines dominate the news, global investors quietly move billions. Hedge funds shift portfolios. Central banks adjust positions. Pension funds rebalance risk. These moves shape the market far more than retail traders chasing headlines. The dollar doesn't move because a small trader buys EUR/USD. It moves because institutions shift billions into or out of treasuries. Stocks don't rally because one person bought Apple shares. They rally because major funds reposition. Shutdowns make these moves clear. You'll see sharp rallies or sudden sell-offs, not because of fundamentals, but because the big players decided to move money. The lesson for traders is humbling. You are not the driver, you are the passenger. And if you try to fight the big players, you'll get run over. Your job isn't to outmuscle the market. Your job is to read the flow, follow the money, and position yourself in line with it. Shutdowns expose how markets really work. They show you that headlines are distractions, but the real story is capital flow. Who is buying, who is selling, and where the big players are positioning. If you can track that, you don't need to predict, you just need to follow. Lesson 4 is this: shutdowns remind traders that the market isn't fair and it isn't equal. But if you learn to respect the flow instead of fighting it, you can still win. Point 5, every crisis creates opportunity. Shutdowns are painful. Workers go unpaid, businesses suffer, markets shake. But in every crisis, there is movement, and in trading, movement means opportunity. For disciplined traders, shutdowns are not disasters, they are chances. Volatility increases, prices swing. Safe havens like gold, the yen, and the Swiss franc rally. The dollar moves in unpredictable ways. Stocks collapse and rebound. If you know how to wait, how to position carefully, and how to strike at the right time, shutdowns create trades you may not see in calmer markets. But the key is patience. Shutdowns trap those who jump in too early. They crush gamblers who bet their entire account on one headline. The real opportunities come when the dust begins to settle, when patterns emerge, and when the emotional traders have been wiped out. History shows this. In past shutdowns, markets dropped sharply, only to rebound once deals were struck. Traders who had the patience to wait, who managed their risk, and who trusted their system were rewarded. Those who panicked or chased headlines were destroyed. The lesson is timeless. Every crisis creates opportunity, but only for those prepared to seize it. Shutdowns prove that volatility is a gift if you know how to handle it. But like fire, if you don't respect it, it will burn you alive. Point 60, trust is fragile. Respect its shutdowns expose the fragility of trust. America is the world's largest economy, and its currency is the world's reserve. But every shutdown chips away at that trust. Investors start to question America's reliability. Citizens lose faith in their leaders. Global markets wonder if the US can be counted on. For traders, the lesson is deeply personal. Trust is everything. Your strategy works because you trust it. Your capital grows because you trust your risk rules. Your trading discipline holds because you trust yourself to follow it. Break that trust even once, and it's hard to rebuild. Think about what happens when politicians fail. The shutdown doesn't just stop services. It damages confidence. Once confidence is shaken, it takes longer to rebuild than it did to break. The same is true for your account. Blow it up once, and rebuilding takes months or years. Break your own trading rules once. Suddenly, the habit of breaking them spreads. Shutdowns remind us that systems, whether political or personal, are built on trust. When that trust is respected, everything runs smoothly. When it is broken, the fallout is severe. Traders who respect their rules, their systems, and their discipline thrive. Those who don't collapse. Lesson 6 is clear. Shutdowns prove that trust is fragile. Respect it. Protect it. Because whether it's America's credibility or your trading account, once trust is broken, nothing is ever the same. Conclusion, America's shutdowns are political crisis, but for traders, they're lessons carved in stone. They teach us that uncertainty kills, discipline wins, risk management is survival, big players control the flow, crises create opportunity, and trust is fragile. The market doesn't care about Washington's excuses. It doesn't care about debates or press conferences. It only cares about fear, confidence, and capital flow. And the trader who learns these lessons won't just survive shutdowns, they'll thrive in them. Because in the end, shutdowns remind us of the ultimate truth. We don't control the market, but we do control ourselves. And that's the only edge that lasts.